Hello again, fellow BeachBum traders. Thank you for joining us for part one of our weekly trading game plan for the week of October 10th through October 14th, titled Don't Move Until You See It. And that's a quote, one of my favorite quotes from the movie Searching for Bobby Fischer. I love that movie. Hopefully, you all have seen it. If not, I would highly recommend it. And we'll talk about how trading can be like chess and what does this mean. Don't move until you see it, as our strategies for part of our game plan for this week and moving forward. So again, thank you all for joining us. We'll do our market analysis, look at what's happened in the markets the past week, and then towards the end, we'll talk about strategies for how we're going to make money trading for the week of October 10th through October 14th and going forward. So thank you to all of you that are joining us in the live chat for our live stream. Thank you again, Spacula, for that super chat and welcome. I saw Nug M and Walter Lyons. I see Pawn Trades. Thank you for joining us. Glad to see you as well. So we'll go ahead and get started. So here's our Google document with our notes for our weekly trading game plans, and I believe the link for this is in the description box below. If not, I'll put the direct link in a comment when we finish. But this and other Google documents with our notes from our weekly trading game plans are in a publicly accessible Google Drive folder, and the link for that will definitely be in the description box below so that you can refer back to these notes, these strategies, and also access the links to all the tools and resources that we're showing and using as we go through our game plans. So we'll start out in FinViz, and we'll start on the home page. We'll see where the markets ended up on Friday. Of course, Friday was pretty ugly, as everyone kind of knows. We'll talk about why did we get such a negative reaction to the jobs report, which is the main cause for this negative reaction on Friday. We could see all the indices declined, between 2, 3, 4%. So again, very negative reaction to that jobs report, and we'll talk about why, and hopefully, again, we've been saying we've been in a bear market. We've discussed strategies for how to make money in a bear market. So hopefully, you were able to apply those strategies and make money on this decline. So we can see, vast majority of stocks declines, 84%, 94 hit new lows, 83% are below their 50-day moving average, and 82% are below their 200-day moving average. So all indications very bearish. Again, very little green in there at all. We can look at some of the news. Yeah, so people, there's a lot of fear. This caused a pretty dramatic negative reaction. So there's a lot of fear. Talk about, and I'll refer you to an article about the jobs report and the decline there. So if we look at some of the futures, the other thing that came out this week is OPEC cut their production quota by 2 million. You'll hear 2 million barrels, and you'll hear discussions that it's not really 2 million barrels coming off the markets, as they weren't maxing out their quotas anyway. But eventually that did cause the oil prices to start to go up, broke over 90, still looks like it's headed up. So we'll trade oil accordingly right now. Natural gas had a little blip, and we'll see the inventory numbers. It blipped above 7 for a while, and now it's back down below 7, and it looks like it's dropping. And then gold struggling above 1700, made it above 1700, and then struggled a little bit to move up. And again, part of that is we see the dollar strength. So we'll see that in the dollar futures, but we see the euro. It had tested going back up to parity with the dollar and then failed and rolled over. And now you can see it's about 97 cents on the dollar. Also, we saw the rebound in the British pound with the quantitative easing going on in Britain. So, and then we saw the treasuries ran back up again on that jobs data. Treasuries, you can see they're not as inverted, but they're all testing that 4% level. Again, we'll talk about the fact that with this jobs report, the inevitability of further rate hikes by the Fed kind of sunk in, and we've been talking about this for weeks. So we didn't. Hopefully, you didn't expect anything different, and you shouldn't expect anything different. We've been talking about a increasing interest rate environment for months now, and how to trade that. So. This was just confirmation that the Fed's going to stay hawkish, and we expect the interest rate hikes that we've talked about. So we'll quickly look at the indices. I'm trying to keep up with the chat. Glad to see you all chatting away. Great community here. I'm glad that you're all joining. Good morning, David Spielvogel. Glad to see you as well. So if we look at the SPY, we saw early this week, and we got this attempt at a run up. So we had this bull rally in the bear market, and then with a couple points of data, economic data that came out that were negative, it plunged on Thursday, Friday. So we'll zoom out a little bit. So again, clearly we're still in a bear market. We're making lower lows. So we broke even that previous low. Again, below the moving averages. This is an ugly candle as well. So morning star, or whatever they want to call that type of candle, but it's a very negative indicator. Again, so that would say, watch out below. It looks like further downside. And again, that's kind of what we expect. So we saw that brief rally and then down. So we'll look at the Qs. They're probably all going to look about the same. Yep, they're almost identical in terms of their candles on the weekly basis. It's a little bit farther away potentially from its moving average, but again, very bearish. It looks like more downside to come. So we're going to strategize and trade accordingly, right, everyone? The Dow actually, it looks a little more positive. So it rebounded off that low a little bit, still quite a bit a ways from its moving average, not quite as negative. So Dow stocks a little bit more resilient. Russell. And Russell pretty negative as well, but maybe it's trying to find a bottom. But again, with rising interest rates, etc., there's going to be a lot of stress on small caps as well. So we'll look at the VIX. The VIX really didn't react a whole lot to this. We'll talk about, again, our strategies for trading volatility, but I mean, it went over 30, so it's sitting at 3160, but I mean, we didn't see, an all-out capitulation. We still haven't seen a capitulation in any of the markets where we get, just everyone bails, jumps out. We hit that bottom with a nice wick tail, and we get a high VIX rating. We're still not getting that. So maybe Monday we'll get that, but it's just been perking up above 30 and then kind of consolidating. So we'll see. Checking some of the comments. Okay, so again, if I'm missing your question, please repost it in the comments. I'll try to catch them. I'm trying to keep up as best I'm able. So let's look at some of the groups and sectors. Again, there's still, even though the markets are declining, there are plenty of ways to make money, both in just playing the bearish side. We've talked about various ways to do that. Obviously, you can short individual stocks. We also have presented a number of inverse ETFs, which is typically how we play things, short things, because we're in a retirement account. So plenty of strategies to make money in this bear market. So we can see everything was pretty much down on Friday. Energy was the most resilient, with oil really driving that whole push. Right now, oil sitting in the 93s. It's up, showing up 5%. We'll see natural gas actually. Well, we saw it declined. Actually, bounced off the $7 place and bounced down. So thank you, Specula, for reminding people, if you like this content, we hope you'll hit the like button. We hope you'll subscribe to our BeachBum Trading YouTube channel. join us in the Discord. Our Discord's free to join, and we'll highlight that in a few minutes as well. So we see the other, on Friday, the defensive sectors, energy, consumer defensive utilities held up. Financials, again, expecting higher interest rates. Technology, consumer cyclical got hit the hardest. Communication services for the week. Again, energy, basic materials were positive for the week. Real estate utilities were actually negative for the week. And again, the only thing green for the month right now is energy. So you can kind of see where the long-term theme is. It's obviously energy, basic materials. We're seeing some rotation. You see utilities kind of rotating in and out. Real estate's been beaten up quite a bit. So we may see a rotation back into real estate. And part of that, I'll babble about that for a second, is I don't think they're discriminating between mortgage-based real estate, like mortgage-backed REITs, which are going to get hurt by rising interest rates because mortgage rates go up, versus non-mortgage-backed REITs and real estate. So maybe they'll start to discriminate that, and that might be an opportunity. So if we quickly look at some of the industry breakdown, again, all very negative. We see oil, mostly oil, gas, etc. at the top of the list. Bottom of the list, silver. Silver got hit pretty hard on Friday. Again, dollar strength. Negative. Semiconductors is an interesting topic, and we'll talk about that probably more tomorrow, about our strategy with playing semiconductors. But AMD came out with bad guidance. That pushed semiconductors down, just as well as just the overall negative market sentiment. Also, Biden came out and further restricted semiconductors and technology exports to China. So again, couple pieces of negative news really drove semiconductors down, and we'll again talk about opportunities there. And gold and silver got hit pretty hard on Friday, again with dollar strength for the week. Oil, again, energy, coal. Silver and gold were actually trying to rebound until the job news and things got negative. We'll see that in the futures. And we see solar and some real estates on the bottom for the week. So again, monthly, energy, silver, gold are outperforming. And real estate also, we've talked last week about some potential opportunities in the area of aluminum. And again, we'll see on our watch list tomorrow how we're looking to play potential opportunities in the aluminum sector. So good morning, Tanbir. Glad to see you. Thank you for joining us. Tanbir says, I took a position in XLE. Yep. A lot of energy strength, as well as a lot of sector rotation in and out of energy. So watch for, as we've been talking for weeks, is they've been rotating in and out of energy. So a lot of people will probably pile into it when it goes down, take profits when it goes up. Again, we're seeing this constant sector rotation in and out of energy. Also, we talked about uranium and how we're looking for some discrimination between oil, natural gas, uranium, coal, etc., and opportunities in that area. So again, I've got the link to this video. You can, how to use this groups tab, how you can drill down, see individual stocks in those various industries, sectors, etc. So I won't belabor that. I'll talk about some of the economic data that we got, and we got a lot, and it did obviously have an impact on the markets. Again, none of this is financial advice. We're not financial advisors, and this is for educational and entertainment purposes only. So hopefully it is educational. I don't know about entertaining, but I'll try. So you'll see we had a bunch of FOMC meeting members talk, and pretty much, and this is what I said last week, I believe, and I'll just reiterate, I don't expect them to change their stance. They're just going to reinforce what they said at the last Fed decision meeting, which, they're going to raise rates. They need to kill inflation. If there's damage to the employment market, to the economy, they'll accept that to get inflation under control. So I don't expect any of that to change. I don't expect them to back off from interest rate hikes, and we're going to see the data is pretty much supporting that, and the market reacted again with the jobs data that, yeah, nothing's changed. They're going to raise interest rates. Unemployment's not really coming down. We're in a recession, as we can see, so some of this data supports that. See, manufacturing PMI was pretty much in line, but this ISM employment was down. So manufacturers are employing fewer people. The PMI manufacturing was down a bit. Prices were down a little bit. So this is part of why the market ran up early in the week. It seemed to say, okay, well, maybe inflation might be cooling down a little bit. So then we see car sales, etc. Durable orders, about in line. The first indication was the jobs, the open jobs position. So you see that was down more than expected. And so that means either job openings are being taken off the market or they're being filled, right? This says the number of open jobs. It doesn't tell you necessarily why. Are they being filled, or are those open jobs being removed from the market? But this seemed to indicate to the market that, well, maybe the jobs employment market is tightening up a bit, and that's what the Fed wanted. So again, the markets ran up through the beginning of the week, and we got mortgage rates are up. So again, that hits the real estate market. Then we got this ADP number, and it was a little high. So again, that tells us, okay, more people are on payroll than was expected. So we're not seeing unemployment. So again, maybe the job market's tightening a little bit. Trade balance wasn't terribly important. Non-manufacturing PMI is a little bit up. This was interesting. Is crude oil inventories. This was Wednesday. Was a negative. So there was a drawdown on inventory. So one would have expected crude oil prices to come down, but then we got the OPEC meeting and they cut production. So you expected oil prices to spike up on that. We've got less supply on both an inventory basis and an OPEC basis. And eventually oil prices did shoot back up. So same thing with gasoline inventories, major drawdown. So again, supply of gasoline's down, supply of oil's down, OPEC's supplying less, and you heard now Biden's talking to Venezuela about letting them export oil. So we'll see what happens there. Obviously, that would increase global supply and might bring the prices down. He also talked about continuing to put oil into the market from the Strategic Petroleum Reserve. So they're going to continue that. So that will increase supply a little bit. But I expect oil prices to continue to go up. I'm not sure how high. We'll have to watch it. They are very volatile. So, trend up, but unless we get further news. Then again, on Thursday, we got natural gas storage, and again, the storage was up. So we've got more natural gas than was expected, and there was a strange reaction to that. I don't know if our other BeachBum traders are trying to scalp, day trade natural gas, for example, using cold and boil. Cold is the short on natural gas, boil is the long on natural gas. But there was a strange reaction to this because you would think increased storage price would go down, but they ran it up, and then eventually it turned and went down. So again, natural gas prices trading is very volatile, but there are some significant opportunities for short-term traders to make a lot of money trading that as well. You just need to be careful. So yes, I agree. That was my point, Walter. Is Walter says natural gas was weird. Yes, the reaction to that data was strange. That we have more supply and they ran the price up. But sometimes they do that, and maybe it's a position where everyone was positioned at the time and they were trying to get out of those positions. Right now, again, natural gas is down like 5%. It's at 660. So eventually it did go trend back down. So then Friday we got the jobs data, and that's what caused the major dump in the markets. We can see average hourly earnings was in line, but it's not going down. So that's an inflationary factor. So the Fed wants to see less pressure on earnings. They don't want to see a wage price spiral. So, and then again, payrolls were up. So participation rate was not up. So again, um, you don't really have people coming back into the workforce, and that doesn't account for it. And then the payrolls again was much higher than expected, and the unemployment rate was not significantly changed. So it's only 3.5 versus 3.7. So essentially all this says there's a very resilient jobs market. So the Fed can be very aggressive. They're not, unemployment's not increasing dramatically. Therefore, again, they can be very aggressive with their rate hikes and not worry about the employment rate spiking too quickly. So here's a link to an article that talks about this in further detail. So employment rate drops to 3.5, which is still a very low unemployment rate. The economy gained jobs, so you're not seeing a net job loss. Again, some of the open positions are decreasing, but again, they're adding jobs. So again, the employment market is very resilient, so the Fed can continue to be very aggressive. And so that's what we would expect. And again, the market didn't like that. I don't know why, they were thinking the Fed would back off from what they've been telling everyone over and over, that they're going to kill inflation, so they're going to have to raise interest rates and do quantitative tightening until they get inflation under wraps. And there's no indication that they're making really significant progress on curbing inflation. So Walter Lyons asked, is there cyclicality in the labor market? And yes, there is, particularly as we're headed into the holidays. But we've also heard, typically your retailers, your transport, your UPS, your FedEx, etc., hire more people for seasonal workers for the holidays. But we've already heard that people like Walmart, Target, I think even maybe UPS or FedEx has come out and said they're hiring fewer people than they typically do for this year. So that tells you they're already seeing a quote recession in their business, because they're not hiring fewer people for this upcoming holiday season than they did, say, last year. They're still hiring, so there's going to be an increase. Again, more people employed during the holidays, so the the number of jobs filled, the payrolls, etc., are going to keep going up. And if you just look at that as a general number, again, the Fed's going to say, well, the employment, we don't have an unemployment problem. The job market's resilient. We can raise rates and not worry about it. Now, typically those seasonal workers, again, they're hired seasonally. So in January, they get laid off, and therefore potentially unemployment may go up. But again, that's going to be after the Fed has raised their interest rates. The projection is for at least another 1.25%. From where they're at right now. I hear the consensus is a 75 basis point in November, 50 in December, but we could very easily have, 275s if inflation doesn't show signs of abating. And again, my opinion, not financial advice, but I see no reason to expect inflation to come down this year. I don't think we're going to see it. until first quarter next year. I think people are going to spend their money through the end of the year, and that's going to, the inflation numbers are going to show no significant decrease in inflation until we get into next year. Again, my opinion, but that's how we're positioning accordingly. So we'll quickly look at what do we got coming up for economic data next week. Oh, and just a quick reminder, since we were looking at the economic data from last week, is as that data comes out, I typically capture it, snapshot that table that we were seeing in our notes as well from investing.com, and I paste it in the Surf the Markets Reports channel in our Discord as quickly as I can, along with the raw data. So you can get that data directly in investing.com or from our Surf the Markets channel in our Discord. Again, our Discord's free to join. We would invite and encourage you to join in the conversations. And again, it's free to join our Discord. You can find an invite in the description box below, as well as on our link section of our homepage. Our homepage is beachbumtrading.com, bum without the U. And again, we have links to all our social media, including an invite to our Discord. Again, free to join. And as this economic data comes out, as well as other things, some observations of trends in the market, etc., I will post in and other people may post in the Surf the Markets Reports channel, so you can see. Occasionally I'll look at futures and give you some indication of what I'm seeing in the futures, as well as reminders of upcoming economic data. So I hope that all helps. So again, if we see what we've got more Fed presidents talking. Again, I don't expect anything different than what they've been saying. They need to kill inflation. The job market's resilient. Inflation doesn't seem to be coming down, so they're going to need to raise rates. So that's what I expect coming out of that. All of them to enforce what we've been hearing. So not a whole lot otherwise on Monday, Tuesday. Wednesday, we get typical data, mortgage data, OPEC report, PPI. Now, these are all going to be important inflationary data. Again, if this data doesn't show any decrease in inflation, the market's not going to like that, right? They want to see these numbers come down to indicate that inflation's abating. I don't expect to see that. We get the FOMC meeting minutes, so late 2 o'clock on Wednesday. This is the minutes from the last Fed meeting back in September. Again, I don't expect any surprises and just reinforcement of what's been said. But, the market and people, other traders are going to be watching for any indication of anything different from what they already said coming out of those minutes. So that there will probably be increased volatility right around that time. So keep an eye on the volatility around 2 p.m. on Wednesday. And we get the CPI data for September. Again, these are revisions to September data. So again, if this does not show significant progress in inflation, the market's not going to like that. And there's going to be volatility around these announcements. And unfortunately, they're before market open. So again, both the PPI data and the CPI data is potential for volatility, as well as causing the market to decline if it's not showing a decrease in inflation. Then we've got jobless data. And they're expecting jobless claims to go up. If they don't, again, resilient job market's not going to like that, because that says the Fed can be hawkish, aggressive, and Friday typical retail. And we get consumer sentiment, so they're expecting pretty much in line, slight improvements in consumer sentiment. So. And again, as this data comes out, I'll try to post it in that Surf the Markets channel reports in our Discord as soon as I'm able. So I hope that all helps. So Tanabir says, yes, earnings season starts in November. It'll be ugly for most large and mega caps, especially with strong DXY. Yeah, we've talked about the impact on different companies due to dollar strength. So I probably won't reiterate that right now. Grab a drink, and then we'll go on to look at the markets. So just a quick reminder, the next FOMC meeting is not till November, so there is no October meeting. So all we're going to get is them coming out talking and the release of the minutes, and everybody's going to be speculating on what the economic data will cause them to decide in November. So again, they're speculating again and reacting to the data, trying to guess what they're going to do in these subsequent meetings. So as Tanabir pointed out, we don't have a whole lot of earnings coming up. It doesn't really start till November, so you can see it's pretty light. You can see if anything is coming out that might affect you. There is some financials, some airlines, etc. So, but the bulk is still won't come out till early November. You check the chat, grab a drink a sec. Okay, so we're going to look at the market screen in Webull. Just a quick reminder, Webull's still offering their 12 free stocks if you open and fund an account. Again, Webull's our favorite trading platform. You can see how I use it for both analysis and trading. And again, you get 2 free stocks up to $300 just for opening an account, and then up to 10 more free stocks for valued up to $3,000 for just putting in any amount, a dollar, whatever. So again, if you're not already using Webull, we would recommend it. It's our favorite trading platform, and you could see how we use it for analysis here, and then tomorrow you'll see how we use it for our various watch lists for charting, etc. So we can see the decline on Friday. There's a significant bump. The majority of the decliners was in the 2 to 5% range. So that's significant. Very few really advanced. See pretty major outflow again. Like last week, we see the Nasdaq started out above the NYSE and then went decline further. Again, the Nasdaq got hit pretty hard. Again, just for your information, if you want to see upcoming earnings, you can hit the calendar earnings. It'll show you the near-term earnings calendar, just a useful feature in general in this Webull's market screen. So let's look at the best performing indices or industries for the week, which will be more interesting because we had a mixed week. We had up early in the week and then hard down at the end of the week. So we see energy. See, home building surprisingly was positive. Transports was positive for the week. Household goods. So a lot of positivity for the week. Even retail, metals and mining, even hotels. So for the week there was a lot of positivity. It was just mainly at the end of the week with that jobs data. Aerospace and defense was positive. We had a merger with L3 Harris and part of Viasat. And again, a lot of energy was positive, so that's good. So look at the markets. I expect it to be down. Yeah, Dow down, NASDAQ down, VIX up. And again, I posted, you'll see in the Discord, when that jobs data come out, I pretty quickly posted that all the inverse ETFs were running up, the VIX was running up, etc. So that was pretty much a pretty quick reaction. So down on the S&P, down on the Russell. So again, these these are ETFs that you can play long to short the indices and long the VIX. So again, plenty of ways to make money in the bear market, just like any other market. So industries for the day, it's going to be pretty much all red. Commodities, so oil, again, energy, it's all oil. So oil was the only commodity, really running on Friday. Look at bonds. Bonds took a beating because of again, raising interest rates. So bond yields go up, prices go down. So the 7 to 10s were doing okay. 3 to 7. So the short end of the yield curve is more attractive, has higher yield, so it's going to be more attractive. So again, thank you for your positive comments, Specula, for all your support. If I didn't already thank you again for the super chat earlier, thank you again for that super chat, for all your support. Specula's been one of our biggest supporters, greatest supporters, longtime supporters, so we greatly appreciate all his help and support. Couldn't do it without you, Spec. Thank you. Okay. So let's look at the futures. Just an FYI, I'll just flash this real quick because FINMA's got a crypto channel or tab as well. As I typically flip this over just to kind of see, okay, crypto's down, Bitcoin under 20,000. It tells me a little bit about risk off move as well. If you get a risk off, which Friday was definitely a risk off day after the jobs data, crypto's going to drop. It also tends to drop with technology. So again, I'll look at it real quickly to see what, is this just a standard risk off or is there some discrimination? So again, we see, ran up. We had a good run up early in the week. We'll talk tomorrow about how we played that run up and made some nice profit on the run up, and we peaked and we dumped back down. So, and very clearly, we're still in a bear market. The question is, where's the next low going to be? Is it going to be a higher low or a lower low? And there's no way to tell yet until we get there. And so that's why the title of this is "Don't Move Till You See It," right? And we'll talk more about strategies about how to use that. But again, it's unclear as to, are we going to make a lower low or are we going to turn before that? And if we make a lower low, where is it? Russell, same way. We see the spike in the VIX. But again, is the VIX going to make a higher high? Are we going to get that, capitulation peak? I personally am hoping so, and I'll tell you how I'm playing that tomorrow. But again, it's not clear. Or are we going to go into a VIX consolidation phase again? Is it going to then retrace a little bit till we get some more news causing it to spike? So we see the spike up in oil on the OPEC news, etc. See, all the oils ran up. So again, no reason that we might get a slight retracement. Typically, when you get a big run up, you're going to get a slight retracement, and then it may continue on the upside. So I wouldn't be surprised. Anytime I see a big run up, a big bar in one of these, I would expect a reactionary bar in the other direction. So that's your typical harmonic oscillator. We talked about that a long time ago. With the pit and the pendulum is typically, if you get a severe reaction in one direction, you're going to get a reaction going back the other direction. The question is the degrees and where does it find the new stable state. So gold and silver, we see it was making a nice run up and then peaked and dumped as we had, dollar strength, which puts pressure on all the dollar denominated commodities, which again, oil's running against that trend. But gold and silver, as the dollar strengthened, that put pressure on the gold and silver, as well as things like copper. See, other commodities are running all over the place. So we got bonds, and bonds were starting to make a recovery, and then we got essentially the news that, okay, we expect interest rates to go up, and then of course the bonds declined. See, the yields had to go up, so prices went down. We also hear people like Japan, possibly China, are potentially selling bonds because of the dollar strength. We talked about that last week. So, and then we see again the dollar strength. It was declining, got down to about 110, and then bounced again as we got inflation's not abating, job market's still strong. So interest rates are going to go up. So they reacted accordingly, and the dollars start going back up. And so our comments on dollar strength and how to play that. So the euro came down, the pound came down, even the yen came down, even though they're trying to support the yen and their quantitative easing and the British pound. So I hope that all helps. Just checking for any questions. You guys are having a good discussion. Love to see that. So got a great BeachBum trading community. Again, if you're not already a member of our community, join our Discord, subscribe to our channel, join the community. Got a great community of traders. They help each other out. So that's what we want to see. That's our objective here, is to share knowledge, help you learn how to succeed in your trading, no matter what the kind of market. So that's what we're trying to do. So the title to this, again, is Don't Move Till You See It. So again, with all this chop in the market, as you'll see tomorrow, I hope you'll all come back and we will use these market analysis, use these strategies to pick our stocks, ETFs, etc., that we're going to put on our various watch lists for trading for the week of October 10th through the 14th. So come back tomorrow for our individual stocks. If you've got any stocks you want us to look at tomorrow, individual tickers, you can post those and request that in our Discord or as a comment to this video, etc., and we can take a look at them then. But again, with the choppiness and the indecision, etc., I've been wanting to use this quote for a long time. Again, this is one of my favorite quotes from one of my favorite movies, Searching for Bobby Fischer. It says, "Don't move until you see it." And again, if you haven't seen the movie, you can see the analogy more. But I wanted to use that chess analogy, and I am not a great chess player. I'm not never got real serious about it, but I do like the analogy here. And that's a recommendation, again, not financial advice, but you don't have to trade every day. You don't have to jump on every trade, or again, you don't have to make a trade every day. If you don't see it and it doesn't fit your trading style, or it's not a setup that looks like a high probability good risk reward setup for your type of trading, then don't take it. You just wait till you see one that fits your trading style. It's got good probability that you're going to make money, you're going to be successful, and then move. So a couple things I want to babble a little bit, or point out at least, is how swing trading, I think, is like chess. So I want to draw some analogies in that area. And again, I'm mostly a swing trader, so this primarily applies more to swing trading. But in chess, you think moves ahead, and same way in swing trading. And with our strategies, we're trying to think of what we're looking for opportunities where something's moving at a support and is likely to reverse and go up, whether that be a long position or a short position. So we've been talking about things like semiconductors and aluminum and potentials in uranium, etc. Is we're trying to think of moves ahead. What's the next move? Are these things going to reverse and go the other direction? Oil, when is oil going to peak and reverse, and with seasonality, etc. So, same thing with the interest rates and all that. We're trying to think ahead. What's the Fed going to do? How potentially is the market going to react? and how can we position ourselves to make money based on those further moves in the future. So, like I said, think about what's going to happen in the future, what potentially could happen in the future. How can we plan trades? How can we position ourselves to make money in those areas? And I suggest visualizing is when we get this kind of economic data coming out. Etc. We get Fed decisions. Is okay. What are you going to do if the Fed hikes 75 basis points? What's your trading plan? What's your trading plan if they only hike 50? And the market would tend to like that. But again, what's your trading plan? What are you going to go long? What are you going to short based on that? If the CPI data is better than expected, what are you going to do? If it's worse than expected, what are you going to do? So. Know your opponent. That's a chess analogy. Really, we're not competing against really anybody in the market. Is your opponent here is the market, and it's market sentiment. In my humble opinion, again, not financial advice, but I believe that the market moves on emotion. It moves on sentiment. So if the market's starting to set an expectation like they did that the Fed's not going to be as aggressive as they said they were going to be, and then the data does not support that unreasonable expectation, the market reacts negatively, right? So we saw they tried to run the market early in the week, despite all indications are we're in a recession. They're going to raise interest rates. Why is the market going up? Well, because it's a euphoric that they want the market. They want to try to run the market. Again, would not be at all surprised to see more runs like that. Bull rallies in this bear market, and so be prepared for that. When you see it, again, when we see one of those bull rallies start, know how you're going to play it because it's a great opportunity to make money. We made really nice profit when we saw that rally and capitalized on it. So I'm looking forward to the next one. And again, we'll talk about tomorrow how we're going to play that in terms of individual stocks, ETFs, etc. In chess, you make sacrifices. Sometimes you sacrifice your queen to get a better position to guarantee that you're going to be able to, checkmate at the end of the game. And it's true in trading too. Sometimes you're going to take a loss to get the cash so you can deploy the cash in a more potentially profitable trade. So I think it applies. And I don't want to run this too long, so I won't babble too much, but learning, learn from your wins and losses. So review, you'll see one of the other things I talk about is things to do while you're waiting to see it, waiting to see the setup that you can take that's going to be profitable, is review your trades and learn from them. What can you do better to ensure you have more wins, better wins, etc., and learn from others. Watch other people's trades. Learn from what are they doing that you could benefit from, or what are they doing that you should avoid. So just like people do in chess, is they study previous games, they study their previous games, other previous games, particularly masters, and they try to learn from those. So. Canterbury asked about the chess news. Yeah, I saw that. I didn't pay a whole lot of attention, but yes, I did see that. And no, that's not really what triggered uh, my desire to do a chess theme this week. But so again, overall, don't move until you see it. There's the chess analogies. Also, I pointed out, the difference between speed and championship type chesses. There's a difference. So if you draw an analogy between speed chess and something like day trading, short-term scalping, short-term swings, etc., the skills, techniques, etc., and that type of trading is different from, longer term swing trading, momentum breakout, and investing, So the skills are different. Know what skills apply to the type of game that you're playing so that you can win, right? So the next thing, and y'all, if you've been around for any length of time, you've heard me say this over and over, patience pays. Is, wait till you get a trade that fits your style, got the setup that you like, good risk reward, high probability of success, and that will pay off, in my humble opinion. So again, some things I wanted to mention of positive actions you can take while you're waiting to see it is, again, review and learn from your trades, build and update your shopping list. And tomorrow, again, we'll talk about various strategies for adding to or culling and making sure that the things on your shopping list are going to be recession proof, proof against rising interest rates, etc. Do your due diligence. If there's a stock that you're interested in and you haven't done your due diligence on it, here's a good opportunity to do that. Tanaver says, I'm surprised to see coal going up with higher oil prices. Okay. I'm guessing heading on both sides. So coal is natural gas. So cold, KOLD, is the short on natural gas. So oil, and another aspect of coal is it's not directly related to natural gas prices. It's actually comprised, if you look at the composition of the KOLD ETF, it's oil and natural gas, I think, exploration companies. So what drives that particular ETF is actually the companies, the price of the stock of the companies that comprises that index or that ETF. So I'd recommend, if you're interested in trading natural gas, coal, and oil, dig into that ETF, know what comprises it, because again, it's not directly related to the natural gas price, but obviously it's indirectly related. If the price of natural gas is going up, that should benefit those companies, and therefore that ETF should go up. Again, sometimes you'll see an inverse reaction, as Tanavir is pointing out, is natural gas could be going up, but other market pressures on those companies comprising that ETF may be pushing the price of their stock down, and therefore coal could be going down while natural gas is going up. So I hope that makes sense. So again, understand what the relationship is and what's going on in the markets and why that may be happening. There are other ETFs that are more directly related to commodity price. So understand, again, the relationship between the commodity price that you're watching and the composition of the ETF that you're using to play it. That will benefit you. I hope that all helps. So very quickly, some other things you can do. I mentioned due diligence. Part of that, is you can build your universe, your database of, I was going to put stocks, but really it's assets that you're going to trade, be it stocks, ETFs, bonds, whatever it is you want to trade. You can take these opportunities to add to that universe for consideration, build up your database that you can then use going forward. Automate your trading processes. So again, even though it was a little bit slow from a trading standpoint for me this week, I was extremely busy working on automating some other trading processes having to do with covered calls. And you'll see in our other strategy, one of the other things we're doing while we're waiting for the markets to turn around is try to do more with generating profit from covered calls. So I'm automating my processes to try to optimize or improve our covered call strategy. So, and continuous learning, be that reading books, watching YouTube videos, shows, etc. Keep being a student of the market. And if you're looking to make this a full-time thing, be a full-time trader, drive your income from this, you should be continuously learning, improving. And that's what all of these things are all about, is continuously learning from your processes and improving your processes. So again, there's no reason to be bored. I don't recommend trading just because you're bored. Go find something else that's profitable for you to focus on if you find that you're just trading because you're bored. So, and don't take, again, the whole point is don't move till you see it. So don't take trades that don't fit your trading style, are not high probability of profit for you, and that's going to be different for different traders. So. Walter is asking about the automating covered calls, I assume, or automation in general. One of these days, I will talk more about that. I have had other requests. Again, it's just a matter of time and energy, and I've got a lot of things that I'd like to do as I'm able. So I'm going to wrap up quick. So if you have a question, throw it up in the chat. I did leave a lot of our previous strategies that we had talked about, what to do while we're waiting for the market to turn back up. And these are from last week's game plan video, but I left those in there. So again, while we're waiting for the market to turn up, we've got strategies to make money. Also, increasing interest rates, so strategies in that regard. Strong dollar, same thing. Got videos and strategies for that. Also, we talked about with the bonds that there are now alternatives, reasonable alternatives to stocks, and what those are, and also other ways to make money. And then we talked about selling covered calls as one of those additional ways to make money. So. Thank you again, Spacula, for prompting everyone. Yes, if you like this content, please hit the thumbs up. We really want to we want to grow our community we want to grow our BeachBum trading community for the benefit of all of our BeachBum traders. So let people know about our YouTube channel, encourage them, share this with a couple friends. Tell two friends. If we can grow the community, that benefits everyone. Tell them about our Discord. Again, there's an invite in the description box below. Free to join. The more people we have discussing, helping each other out in our Discord is helpful. So again, I'll plug. Here's just a quick plug before I leave today. Is I know it seems like a lot of people got, I'll say, blown out, blown up. They blew up their accounts. They got blown out of the market. And my concern is that they're not going to come back. They're now out of the market. They don't think stock market. They lost money and they'll never come back. And I don't want to see that. That's one of the main reasons I started this whole YouTube thing, is to prevent what I saw in 2008, 2009 and previous crashes, is people get blown up and they leave and they never come back and they miss on the wealth generation opportunity that the markets present. And I'm sure there's quite a few people that happened to and they're gone. And we want to get them back in for their benefit. Is if the market does bottom and turn, or I shouldn't even say if, when it does bottom and turn, that is a generational wealth generating opportunity. And we want to be in at that point and take advantage of that generational wealth generating opportunity. So if you can help us bring those people back, bring them back to our channel, our Discord, etc., and we'll teach them that you can make money in any market, be it a down, bear market, up, bullish market, flat, whatever, range bound. There's ways to make money. So and don't blow up. So there's my plug. That's, again, that was our goal. Is we don't want to see people get hurt, leave the market and miss out on that wealth generating opportunity. So with that, my little soapbox, I will wrap up. So again, please choose to support us by subscribing. Hit the like button to share get the YouTube algorithm to share this with more traders. And please come back tomorrow for part 2 of our weekly trading game plan for the week of October 10th through October 14th, where again we'll apply all this analysis, strategies, etc., to select our individual stocks to put on our watch list for trading next week. So hope this all helps. Let us know in the comments below in our Discord, etc. What do you want to see more of, less of, etc.? how can we improve. Got a suggestion box in the Discord as well for any suggestions you may have or any kinds of improvement. So otherwise, we look forward to seeing you again tomorrow. Thank you for joining us. Have a great day.